why it is, or explaining why it is you think markets are efficient, and we'll get into the different forms of efficiency. Out of respect for your work, I'll let you explain what the efficient market hypothesis is.
It's a very simple statement. It says prices reflect all available information. So basically, in that world, it's impossible to beat the market. That's an extreme form of the hypothesis, the market efficiency hypothesis. But the rub is that it has to be connected to some story about what prices should look like. So you need what we call a market of equilibrium. In other words, how do you measure risk? The market's pricing things correctly. How do you measure risk, and what's the relation between risk and expected return? The main implication that it has for investors is it's very difficult, if not impossible, for an investor to beat the market. So basically, passive investing is the way you want to go. That one has held up every time anybody looks at it in a serious way. So I think that worked back then, and I think it works today. So the main implication as far as investors are concerned.
If your theory were to hold true, then theoretically speaking, the whole asset management industry would be rather pointless, would it not? I mean, why pick stocks when the markets are already factoring in all available information? That was published several years ago, and I quote, "I'm convinced that there is much inefficiency in the market when the price of a stock can be influenced by a herd on Wall Street with prices set at the margin by the most emotional person or the greediest person or the most depressed person. It is hard to argue that the market always prices rationally. In fact, market prices are frequently nonsensical." How would you respond to this?
What's the evidence? That's a claim, but what's the evidence behind it? I don't know of any.
If you could observe market anomalies, huge standard deviations from the mean, would you not at least ask yourself why things are moving the way they are?
No, volatility is inherent in asset prices, especially stock prices. So you expect volatility because information comes in every day, every minute, every second, and that moves prices around from their previous equilibrium values. That's to be expected. So volatility is not a sign of market inefficiency. It's just a sign of lots of information coming in, and maybe people's tastes also changing. The risk premium changing as a consequence.
How would you define market anomalies then?
Market anomaly is very, very difficult to pin it down because you have to tell me what your underlying model is for risk and return. So I can tell whether what you're showing me deviates from that. So one thing is a market inefficiency that has always stood out. So if you look at insider trades, they make money on their trades. Insider trading is profitable to the people who do it. So, but that's one of the few exceptions to the rule. Now, you would expect it would be because they have access to information that nobody else has. That's why we have insider trading laws. But there's a case where for an insider, the market in the insider stock is not efficient. But for everybody else, it could well be efficient. So in other words, he can make money on it or she can make money on it, but nobody else who isn't privy to the same information can do it. So as far as they're concerned, the market is efficient.
On the weak form theory of market efficiency, the theory states that markets move on a short-term basis more or less randomly, also known as a random walk theory. It's more or less pointless to make predictions on a short-term basis. Do you subscribe to this theory?
No, because that's the way people talked about it in the 50s, 1950s, long time back. When they first started to think about these issues, they thought maybe prices should be random walks. But then they figured out that no, we have to have an expected return on it because people are bearing risk. Mm-hmm. So the modern statement is that price variation around the risk-adjusted expected return is random.
Can you expand on that? So you don't think Bitcoin has any intrinsic value?
Well, it depends. So if people use it as a medium of exchange, in other words, they actually conduct transactions in it, then it could have value because then it is a type of money. But, well, it's a unit of account. It's not really, it's just a word, right, that we can give value to because it's used in transactions and it's limited in supply. So in that case, it can have value. But the question is, will people transact in a medium like that has such a volatile value? In other words, what monetary theory says is a unit of account doesn't survive unless it has a fairly stable real value. In other words, its real price can't be going up and down dramatically. And that's not Bitcoin. Bitcoin is all over the place in pricing. So I don't think it can survive as a unit of account. And then it won't have any value. So if it doesn't survive, the people who invest, the people say they're investing in Bitcoin because other people are, watch out.
On paper, worth $21,000 a coin USD today. What is the pricing mechanism behind that number?
I don't know, but I don't think, and I'm not sure that this isn't, I hesitate to say it, but this isn't a case where the market hasn't figured out that this thing has no value.
I see.
We had a crash recently, right? I mean, all the prices of these things, some of them have died. Some of the lesser ones have died, and Bitcoin went down to less than half. So in the future, I think I would expect that to happen again, unless something happens to make its real value more stable. And so people are willing to transact in it.
Okay.
But now, at the moment, my guess is even the crooks don't want to transact in it and hold it. They'll probably transact in it, but then give it up quickly for something else because it's just too risky. It can't be long term. It can't be a store of value unless there's something that gives it value that isn't just people are willing to hold it. It has to have something in it intrinsically useful to make people willing to hold it. Otherwise, that whole story, it won't be a store of value very long. But just because people think it has value, that's going to blow up at some point.
One could argue that speculation is the utility.
That's fine, but I think that utility is short-lived.
Okay.
The speculation can go the other way, and then you're out of business.
What about gold? Do you think gold is an adequate store of value?
Well, gold has some of the same properties in the sense that it's a highly volatile, has a highly volatile price. In the old days, I guess people transacted more in gold than they're willing to do now because they have other mediums of exchange that aren't so variable in price. So people used to say gold was a hedge against inflation. But it isn't. It's a terrible hedge against inflation because its price is too variable relative to the prices of goods and services.
Just on that note, I'd like to ask you very briefly on inflation. Do you have any thoughts as to why inflation is at the highest level in 40 years and what can be done to fix this problem?
Well, that worries me a lot, actually, because way back when the Fed started doing this quantitative easing business, I said, no, they're out of the business of controlling the money supply by controlling the amount of lending that banks can do because of limits on their reserves. Basically, reserves are unlimited now, and they're paying full market interest. So I don't know what's determining the price level anymore because what monetary theory says is you have to have something that has an opportunity cost relative to other assets and is in limited supply. And that's not the case with reserves anymore. So I've been waiting for inflation to come along to see what would the Fed do. In the old days, what it would do is contract the supplies of reserves so that it get some control over the price level that way. But now it thinks it can do it by raising the interest rate on reserves and making people less willing to hold other assets and to do anything else because of the higher interest rate. But then the question is, how high does that interest rate have to go?
Well, that's a good point. In the 80s, Volcker raised it to double digits to match inflation. So if we were to be Volcker-esque, we'd have to get the interest rate up to 9%.
Right. I remember that time very, very well. So that's right. So people have been shocked that they pushed up the federal funds rate from 0, basically, to 75 basis points. But if you're running 8% inflation, 75 basis points is nothing. You got, as you said, you got to get up there. You got to get that rate up to near 8% to make it work. Maybe. Who knows? This regime never existed before. We don't know if it'll work at all. If you have any clue, any way to get hold of to control inflation. We really don't know that. And they don't know it either because they've never had to do it before.
Are you insinuating that the Federal Reserve's efforts right now are in vain?
We don't know because this is the first time anybody ever tried to do it this way. That they had to come out of this quantitative easing business and raise interest rates to try to control inflation. No, we don't know whether that will work or not, or how much higher interest rates have to go to make it work. We just don't know.
Well, to fight inflation, we have to get to the cause of inflation itself. Would you agree with monetarists like Milton Friedman, who have said that inflation is always and everywhere a monetary phenomenon and that it's caused by increases in the money supply?
No. Well, here's the problem with that. See, Milton was right in his time in the way money was defined in those days. So in those days, you had two forms of money, currency and reserves.